Hey, what's up, guys? Andrew here from Trading Options Daily, back with another video. In this video, I'm diving into a market update for this week, what's going on in the markets right now. A lot of fear, a lot of pandemonium going on. Usually these videos are reserved for my coaching clients, my actual stock options elite. But this week, I'm going to give you guys a little bit of an insight into what I'm thinking for the markets right now, what I'm seeing, and we're all going to learn a little bit together. So if you guys are ready to go, we're talking inflation. We're talking monetary policy a little bit today. We're talking about a little bit of a market kind of technical analysis update and just where I kind of see things kind of shaping up as we kind of go through this prolonged down spell in the stock market. So I keep getting so many different kind of messages and questions about when is the market going to bottom out? Truthfully, I don't know. And nobody out there knows for sure. We can just take technical levels that we see on the charts, things that we see in the economy, different factors coming in from the Fed and from President Biden and from Jerome Powell, and kind of put those all together, try to make our best guess scenario. And we're going to get into that right now. So let me share my screen and show you what I'm thinking as we move through this. Get the screen share going here. Boom, boom, desktop 3, and we are into it. So right now, last week on the coaching call, my options elite would have gotten these kind of price levels that I saw as support on the SPY, which is the S&P 500 or the SPY index, and it just tracks the S&P 500. And I had 4 different kind of price targets for that on the downside, and we did bounce off the 405 level at the bottom here for a couple of attempts, and we broke through it earlier in this week. To start the week, we had a day that kind of fought around that line, and even the day after. And today we rejected that line. So this all screams to me that we're going to move lower, even though we're already at the lower Bollinger Band, which just gives us these are just two standard deviations Bollinger Bands. They give us basically a 95% chance that the data is going to stay inside the green lines in this chart. And we're approaching the bottom level here, which technically should indicate that there's some kind of bounce coming, but we have seen a prolonged decline to start the year all the way from back here in January. We've kind of fought back up in March and then decline again through April into May. So I drew in some new lines here today on the price targets for the bottom level, and we went right with these ones just because the market is declining faster than I can draw these lines in. So we need to go with a different color to make sure you guys can differentiate where they are and where when they were drawn in. So red right now, and like I said, like we have, if you haven't used candlesticks before, I'll just explain this quickly. Basically, we had all this kind of buying and selling going on right around this 405 level was the main area of support. It bounced off it here and went back up. It came back down. It kind of tried to bounce back up and close up here. I thought it was a good close on the weekend, on Friday last week. We opened up last week, or this week, sorry, at right that 405 level. We got shot back down. The next day we open up higher, pre-market, get shot back down again. And then today we open right around here, try to go up, and it's an inverse hammer candle. So this looks like, to me, it's going to be another decline tomorrow as we finish off the week, Thursday, Friday. So I'm looking at this kind of move further downward. And these levels in here that I'm looking at now for the potentially market bottom, hopefully, it remains to be seen if it's going to hit it or not, but 369 or 369.5, 350, 338, 325 for different reasons here. We got double bottom on the daily chart for 369. That's the first one going back way over here. We've got some good volume over here. And we have this kind of area here where it's been touched, it's been tapped. If we zoom in over here, it's been kind of tapped once, tried to break through, couldn't do it, went through, kind of rejected it. It's been all over this line basically, and then it went back down and used it as support, and it could bounce higher, went back to touch it again, didn't quite get there, but boom. Right in that 40 or 369, 372 range is the first kind of hurdle that I see the market kind of maybe where it'll catch. Outside of that, then we got 350, which is basically a psychological level, and then because it's a nice round number. But we also have on the weekly chart, we've got a right around the 200-day moving average, which is basically a year's worth of trading data, and the price closes all kind of modeled together on the smooth line. So that's a major psychological support and a major chart like support that people look at. And most traders use the 50 and 200-day or 100-day moving averages. So that is a big one that I'm going to be watching as well. Then we got 338 and 325, and that's basically back to the monthly chart. If we get all the way down there, which definitely could happen, I'm not saying it can't happen, but we could end up all the way back here to the pre-pandemic kind of levels, is why these are in here. If we kind of zoom this chart in, we can see here that 338, this candle right here was February of 2020, right before the pandemic hit and everything went to a halt. The economy kind of shut down, and we kind of hit this high around 350, right around sorry, the 338 line, right around 338 there, we kind of tapped it, went back down, and ended up having a crappy end of February and a really crappy March as the pandemic raged on. But then we have the 325, which is actually the open at that time for the SPY. So those are the kind of the four levels that I'd be watching as we move through this and to see where we're going to catch potentially. But right now, like the hammer candle right here, like we tried to move higher this month already in May. It's only been a couple of days, like a week and a half, but we kind of moved higher. We couldn't, we got shot back down. So like this to me looks like it has room to run, and looks like there's going to be an increase in volume as well. This bar is almost half as big as these ones over here. It's not even half of the month yet. So I'm expecting this to be another kind of spike in volume, and maybe this will flush out the last bit of capitulation in the market, which just means people finally get to the end of where they're fed up, they're done, they just throw in the towel, and the market kind of recover once there's no more kind of leverage in place, which is the next topic we're talking about today, is the leveraging of the hedge funds. So when you guys see this kind of crazy strong movements, a lot of times it's not retail traders like you and I that have the ability, like it's never that, unless you're into like a GameStop situation with a short squeeze on the Reddit kind of board. Us, like as retail investors, we cannot make these moves happen in the stock market. We don't control enough capital, enough shares. But hedge funds, they can leverage up just like you or I can. Like if I'm a trader and I use trade options in the margin account, I can leverage my money 3 times what I have in my account. So I put $100,000 in, I can trade up to $300,000 worth of stock. And if something goes bad and I make a bad bet and I can't cover my position, I have to sell off, or my actual brokerage will sell off my position for me and then try to recoup some of their loss and protect the downside. But these hedge funds, instead of being 3 to 1, 5 to 1, 10 to 1, some of these hedge funds are like 100 to 1, 300 to 1, 500 to 1 leverage. And that just means that there's so much more selling that has to happen when something like this kind of starts to sell off. If hedge funds are betting that it's going to go up in value, that they're betting the wrong way, they have to sell other positions plus the position that's going wrong for them just to cover. And this creates a tidal wave of momentum and downward pressure in this case. A lot of people would have been having the stock markets kind of bounce back up, and it didn't, it kept declining. And all this leverage kind of gets flushed out of the system. And like you're seeing good companies sell off, you're seeing really bad companies sell off quickly. The companies that bet on these companies to go up higher, the hedge funds that bet them to go up higher, are being flushed out. They're losing money, and they just have to sell off other good, solid names to cover the losses on some of their riskier, leveraged up positions. And this is why you see the kind of this ongoing assault and selling that's happening in the markets. That's one of the reasons, anyway, in my opinion. There's a lot of deleveraging happening. We're almost at a 20% decline for the SPY. I believe the QQQ is already there. It looks like it is there already, and we are off to a rough start to the year, but it is what it is. Sometimes the stock market, yeah, we're at 27%. This is actually worse than the sell-off was during COVID for the QQQ. The NASDAQ, the tech sector has been kind of hit hard, right about the same amount, actually 30%. So it's experienced a pretty significant pullback. And if history repeats itself, hopefully it does, it also experienced a very V-shaped, nice bounce back up to all-time new highs, but we will see if that happens. Don't get your hopes up too quickly. I think there's some other things going on, like inflation right now that the Federal Reserve is trying to tamp down with things like interest rates hikes. And they're in a tough spot, the Fed. So if they raise interest rates, they are effectively going to hopefully cool inflation. But at the same time, if they raise rates too quickly and they make abilities to borrow money, as we all know, we all have to borrow money, or we're trying to borrow money when we can. If they raise those rates too high, you start getting defaults on lines of credit, start getting defaults on mortgages when they go to renewal. If they go to renew and the mortgage is too high, they can't make the payments monthly, the cash flows in there, then people lose their homes, and it just snowballs from there. The real estate market takes a hit, that filters down to the rest of the economy, along with the stock market and the crypto markets all kind of been selling off at the same time. So they're in a really tough position. They've raised rates a couple of times already this year, but to keep on going at it, try to tamper inflation is going to be a tough proposition, just because it's a slippery slope. If they raise too quick, too fast, there can be a lot of pain, and the word recession keeps getting thrown around. If that happens, though, and let's say they can curb inflation, and that does if they don't do that, if they don't raise rates or don't do anything, then if inflation continues to run wild, we're going to see that the average earner like you and I, who earn money with a working wage, your buying power is taken away from you. It's just stolen. Your time is stolen. Imagine going to work for a week, working all those hours, and instead of taking home 100% of your paycheck like you normally would, you're only going to get 80% of it. And that's because goods and services are getting more expensive with inflation. So if the Fed does nothing, doesn't change the interest rates, and this inflation just goes out of control, then your buying power, the time you're putting into work and earn money is being stolen from you, and your dollars can buy you less and less goods, okay, which is a big problem. So that's the kind of the dance that the Fed's trying to do in both the United States, Canada, around the world. Even global economies are kind of on this kind of tilting point where we either go back and kind of reset things, and it's going to be nasty with the recession, or we kind of just let inflation kind of run rampant and see what's going to happen here. The other thing we have to think about in this whole situation is that what has the impact of the Federal Reserve printing more money into existence done to compound this problem? Like, there's a crazy amount of stimulus right here, and this is showing all the money in supply in the United States, okay? And what I want you guys to understand and note is that when we hit 2020, there was a pandemic. There was an issue in March of 2020, okay? Where roughly 16, I believe that's $1 trillion in the US economy, $15 billion, just add one. Yeah, so it's 15 trillion. From that time to right now, there's about $6 billion added to the US economy in their system. $6 billion in 2 years, okay? If we go back to see how long it took for the last 6 billion to get added on, we're looking for the number 9 on this chart, and we got to go all the way back to right around April, May, June of 2020. So roughly 8 years to pump $6 billion and like have it naturally kind of enter the economy. They just did the same thing in 2. And a lot of that money that was going into the economy in a lot of different forms, but I think we're seeing a lot of that money now that was pumped in kind of be destroyed and filtered out through the deleveraging process that we're seeing in the stock market. So there are some definite kind of bigger picture things in play right now, aside from just hedge funds selling off. Like, it's hedge funds, it's the monetary printing that was happening in 2020 that's coming back to bite us in the ass a little bit right now. The inflation numbers are kind of a result of the monetary policy as well, and maybe not raising rates a little bit sooner to kind of cool it to where it's at today. So basically what I'm trying to say is that we have a longer move downward, in my opinion. And if you want to protect yourself, there's a couple of things you can do. You can try to short the market and time the market that way, which is not something that I like to do or something I would recommend. You could do what I like to do and sell put options, so that if you do sell a put option, it's like selling an insurance contract. And at the worst case scenario, you have to buy shares that you want to own anyway. If you do end up catching a market bounce, though, you make a little bit of money quicker in premium money, and you just kind of are protected both ways, as long as you're okay with owning shares. The other thing you can do is just sit on cash right now. Like, even though inflation is kind of taking the buying power away and it's chewing up cash that's sitting and doing nothing, it's still potentially a better move if you're not putting it in the market and fearful of it kind of moving downwards. If you have a long-term time preference, it's not a big deal. But if you're kind of short-term trying to get in and get out of the market, which is hard to do, you don't want to have kind of cash going in, coming out at the wrong time. So maybe you want to just sit on some cash, and that's totally a viable option. To wait for this thing to bottom, wait for kind of this leverage to kind of shake out, wait for it to kind of make that move back up and kind of reaffirm that it's going to be back up in a positive way moving forward. So those are the kind of things you can do to kind of navigate a market like this. It's tough. It's tough on everybody. I'm kind of sitting on my hands right now. Wish I had more money to kind of deploy into certain situations. I'm kind of tapped out myself, but wanted to share this with you guys today. These are my thoughts, what's going on. Like, don't get super nervous and panicked. Like, there is stuff happening, but as long as you have a long-term time preference, and we zoom out on this chart, let's go to the monthly chart on this. Like, the stock market is a mechanism that goes up in value over time. That's what it's always done. And have we had a nice run up here since 2008? Yes, we have. We had some pullbacks along the way. If you go back even further on the SPX, like this is the long term, like since its inception, right back in the 1800s. Like, this is the market long term. It does go back down at certain times, but it does normally move higher. When in doubt, zoom out. Hope you guys enjoyed this coaching call this week. If you want to learn more, I invite you to go to tradingoptionsdaily.com and check out some of the free resources I have there for you guys, absolutely free. I've got a couple of reports, I've got a couple of ebooks, I've got a webinar that I have linked there too. Lots of stuff to get you guys going. If you want to know more about the stock market, I invite you to go to www.tradingoptionsdaily.com and go get started. Okay. Thanks so much, guys. Hope you enjoyed this. I'll see you on the next one.